What is the lowest number of shares you need in order to be paid dividends from UK companies every single month? In this video, I will attempt to answer that question. This is not investment advice and is just for entertainment purposes only. The lowest number of shares you need to achieve this goal will largely depend on which investing platform you have. On most platforms, you can buy individual shares in UK companies. So for the first method, I'm going to see how we can achieve monthly dividends from the fewest large or mid-cap companies in the UK by simple stock picking. I'll then discuss another option available on some platforms only. To receive dividends each month from the fewest number of companies, I'm going to target those which pay out dividends 4 times a year. And here is the list of all the quarterly payers and their dividend yield at the time of this video. Now, this is not a recommendation to buy any of these shares at all. This is simply an experiment to see what the smallest number of large to mid-cap companies you would need to own in order to get paid dividends every single month. Investing in single stocks, especially low numbers of them, is very risky. Different companies pay out their dividends in different months of the year, and by owning a combination of them, we can get paid something every month. Let's first look at who pays when. In January, Eurobox and GSK pay a dividend. British American Tobacco and Games Workshop pay out in February. 5 companies pay out in March, 2 in both April and May, 6 in June, just 1 in July and August, 7 of them in September, 1 in October, 2 in November and 5 in December. The next step is to reduce the number to just 1 a month. Well, as GSK is the only company paying in July and October, it's definitely selected for the team. We can now rule out any other companies which pay in the same month as GSK, so it's bye-bye to Eurobox and HSBC. And we'll eliminate them from all the other months too. Also selected for the team has to be British American Tobacco, as it's the only company paying in August. It also pays in February, May and November, and we can then eliminate others paying in those months too. Now for March, June, September and December, there are 4 companies we could select to make up the third member of our team: BP, Imperial Brands, Shell or Unilever. So if we are picking individual UK large or mid-cap companies to try and get dividends each month, then the minimum number we need is 3. The question now is, which 3 are we going to choose for maximum returns, and will they beat the index they are in? Before we get into it, please tap that like button and consider subscribing to be notified of future video releases. Well, we already know that British American Tobacco has to be included, and the share price is more or less unchanged in the last 5 years. It pays a huge dividend yield of 8.9%, and after looking at historical payments as well as the share price growth, if you had invested £1,000 in British American Tobacco 5 years ago, your holding would now be worth £1,396. GSK also has to be included, and £1,000 invested in its shares 5 years ago would now be worth £1,109. Selecting BP as our third share would give a net value of £1,052, and the average of these 3 is £1,120. And if we compare this to a FTSE 100 ETF, we can see that although with these 3 shares we get paid every single month, we underperform a FTSE 100 ETF, which pays 4 times a year. What happens if we swap BP for Unilever? Well, we've closed the gap a bit, but we are still trailing the FTSE 100 ETF. Replacing Unilever with Shell does significantly better because, as you can see here, the share price of Shell has done relatively well, but we are still trailing a FTSE 100 ETF in total returns. However, if we swap in Imperial Brands, which has shown a share price rise of 23.5%, and also has a hefty dividend yield, then we do actually beat the index over the last 5 years. Do remember that past performance is not a reliable indicator of future returns, and this is only an experiment, not a recommendation. Picking individual shares is risky, and even more so with low numbers of them. So now we can cross off all the others and leave just British American Tobacco, GSK and Imperial Brands as our 3 shares which would over the last 5 years have not only beaten the market but would pay you dividends every single month. Now if we can stretch this to 4 shares, then there is one scenario where much higher returns would have been made. Just look at what happens if we also include the FTSE 250 company Games Workshop Group as our 4th share. The share price of this company is up 160% over the last 5 years, and the average return of these 4 companies would have grown your £1,000 into £1,753 over the last 5 years, comfortably beating the FTSE 100 as well as the FTSE 250 exchange traded funds. Now we have just seen that it is possible to pick just 3 or 4 UK companies and receive dividends each month. But is there any way at all to do this with one single share? Well, believe it or not, there is actually a way to do this on some platforms, and I'll show you an example. First, just a quick reminder that if you want to start your own investing journey, then Trading 212 will start you off with a free share worth up to £100. Just click on the link in the video description to open an account today. Now, how to get paid dividends from UK companies every single month with just one share. The one I'm going to show you is provided by Columbia Threadneedle Investments, and its full name is CT UK Monthly Income Class Z. Just be aware that not all platforms will offer this. A couple I found which do are Hargreaves Lansdown and Fidelity. If you know any more platforms where you can buy this one, then let me know in the comments. And also if you know of similar instruments available on other platforms, then this will be also very helpful. This particular one tracks 53 UK companies over several sectors, which is way less risky than picking 3 or 4 individual companies. It has a dividend yield of 4.1%, dividends are paid monthly, and the total return over the last 5 years is 30.6%. The ongoing charges are 0.83%. On the left you can see the sectors that you would have exposure to, and on the right are the largest holdings within this instrument. This graph shows the 5-year performance, which as you have seen on the previous slide is up 30.6%. But how does it compare to our typical FTSE 100 ETF? Well, with an exchange traded fund such as ISF, you get exposure to all 100 companies in the index. The yield is not too dissimilar, with both being around 4%. ISF of course pays quarterly, and the total return is a little higher, and in terms of ongoing charges it's cheaper. So if you want to invest in UK companies and receiving dividends each month is important to you, then this instrument could be one way of going about it. But the downside of doing this is you will possibly have to sacrifice a bit of performance compared to a trusty old index tracking ETF, which pays out quarterly. To find out more about ETFs and which one might be suitable for you, then click this video here. And to see which shares I hold in my own portfolio, then click this video here. See you next time, and happy investing.